everybody to join. But today we have David with us, who's going to take us through annual planning for sales and marketing. We had a very nice session yesterday, and there was a lot that was being talked about this session. So, yeah, all of us are very excited for this. Before we start, I just wanted to say my name is Pragya. I'm the head of marketing at Rev Genius, and we would not be able to bring this session to you without our lovely partners. So, a quick shout out to them, and then it's going to be all on David. So yeah, we have three partners for today's session for the GTM community. It's Revenue Hero, The Juice, and Seamless.io. Revenue Hero reduces your sales cycle, connects high intent prospects to the right rep from anywhere, and drives more pipeline for you. That's what they do. The Juice is actually somebody we work with very closely, even at Rev Genius. They help brands by sharing their content with your customers, and then the customers get to your website. So they really help you drive traffic. Seamless.ai is their search engine really helps you connect directly with your ideal customers so that you can shorten your sales cycle and get more deals at scale. My radio ad is done. And David, it's over to you so that you can introduce yourself and tell us what we'll be going through in today's session.
Great, thank you, and really appreciate you having me. Excited to go through this today. So my name's David Maxey. I've got a background in consulting, specifically recently leading revenue operations teams, working with product teams, and I've served as the product owner and chief operating officer for a company called MFG.com that was bought by Shapeways about 18 months ago. But I've had the opportunity to run sales teams, pre-sales engineering, enablement, customer success, and portions of finance. I feel like I've gotten really lucky, and I'm grateful that I've been able to work in the different areas. I'm on the West Coast right now, but I'm originally from the South. I lived in Georgia for about 30 years. But since I've moved to the West Coast, I've built 5 revenue operations team, restarted my consulting business, and stay as active as I can in the Rev Genius community. I think it's one of the best communities out there to make sure that you're staying networked, staying up to date with what everybody's doing as the market rapidly changes. So today, that's me. And today, I think the areas of focus that we were going to talk about was really getting to know the key drivers in growth beyond just people, so ramp time and a few other different things. And then talking about the key drivers in marketing, and then how to include these in annual plans. So I think we'll have some questions along the way, but that's kind of a rough outline.
Thank you so much for that. Where do you want to start for today's session, David? Do you have any specific place that you would like to start? Is it the pre-planning stage, or where do you ideally start?
Yeah, so I think we'll start out with let's look back for a minute and let's talk about what's happened probably over the last 18, 24 months and why it's important now. And I think starting with the why is important now. Well, planning session is on us. We're all thinking about 2024 right now. I know we've got to close our quarter out strong. We got one more coming up, and depending on what industry you're in, that could be a busy season or not. But regardless of the fact, we're all thinking about 2024. And so when you're thinking about 2024, but kind of looking back at what happened, we had one of the largest bubbles that has happened since the dot-com bust when it comes to multiples from a private equity and investment standpoint. Companies are now being valued much more over profitability and sustained profitability over growth. I was at SaaStr about 3 weeks ago, and one of the larger firms got up and gave a great presentation, and the value of growth to sustain profitability used to be 6 to 1, and it is now 2 to 1. Still favoring growth, but by a factor of a third less than it was before, which really reinforces that your planning needs to be sound in the sense of durability and being able to sustain risk that you might not be able to plan directly for. And so the reason I say look back, well, what happened before was we did what we always do when a problem happens, is we assume that if we throw more people at a problem, we can probably solve it. And last year, one of the numbers that was thrown out from SaaS businesses that roughly SaaS businesses across hit about 47% attainment last year, which everybody knows that when you're building a plan, that it's very hard to stay profitable when you're at that kind of attainment. And we also saw a lot of risks that happened in last year because we overhired. So when we talk about the key drivers, the things that I'm going to specifically touch on is not capacity, not throwing people at the problem. And it's not that you shouldn't, it's that there's a proper time to. And the proper time to is when you have the other drivers figured out, because that's the definition of scaling. If you're able to scale faster, and when you throw people and you're getting more production out of those people, instead of just flat production, then you started to hit that scaling point. And so that's really where I like to start, is looking back and saying, well, let's not go through and make sure that we're overstaffed, so we don't go through the roller coaster of what we went through. Let's really take a look at and break the business down on the key drivers that we do have control over. And let's talk about why some of these drivers, they might have, some are more compelling and less in businesses, as a genuine statement, general statement. And also some will appeal to other businesses a little bit more, depending on their particular stance. And I can give you a great example, starting out with average selling price. Average selling price is one of those things where, if you're a one product company, and you don't really have a whole lot of land of expand, meaning, when you start your contract out, whatever your unit economic is, you typically get, 90 to 95% of the contract that's ever going to be available for that company. Increasing your average selling price, your only real mechanism through when you're in that particular situation is things like pricing increases. And then it depends on, how much competition you have and how loyal your customers are. And so that's what I'm talking about. A business like that might not look at average selling price. They might look at some of the other drivers that we'll touch on, like sales cycle, conversion rate, or ramp time. So I'll go through each one of those and we'll touch on each one. But before I do, is there any request on an area to start off with, specifically talking about ramp time, average selling price, sales cycle, or conversion rates? Or should I just go from the top and keep going?
Yeah, I think we can go from the top, and I think also it would be nice to later hear a little bit about what you mentioned before in our when we were not live, about capacity and people. So yeah, maybe we can start with ramp time, and then we can dig in.
Yeah, so if ramp time is one of the areas, and I think in every business it is important, and it's commonly overlooked. And the reason that I say it's commonly overlooked is it's usually looked at in a binary sense. You're either ramped or you're not. But as your sales team starts to grow and you start to scale, meaning it goes from 3 to 6 to 9 to 12, you'll start to notice that it's not just about somebody being ramped or not. It's also about how long they've been there. And sometimes you'll see that there'll be particular cohorts of people that will join that their productivity may drop, versus going up. So monitoring your salespeople and what their productivity really is. And productivity is not their quota. Productivity is measured by literally when they start to a particular time frame, either usually 6, 9, or 12 months. How much did they produce in that time frame? That's your ramp time. It's not a gut feeling, but a lot of times it goes, hey, if a rep doesn't sell this in the first quarter, this is what we're expecting. But you should really be looking at the true calculation if you've got the data, and looking at that ramp time. And if it's longer than your industry standard, if you're an enterprise sales cycle and your deals are over $150,000 and you've got a sales cycle that's 95 days, that's pretty good. You're probably not going to spend a whole lot of time compressing that sales cycle, because getting everybody mobilized, getting a PO cut for that amount, that's quick. But if your sales cycle is 14 months, what's important is to start looking at where in the sales cycle can you start compressing. And I'll use an example, one example, and then we can move on, because I could spend 20 minutes on just average or on this particular topic. But a lot of times the ability to pay is archaic, especially on the enterprise side, where you do have to wait for POs. There's a lot of things to jump through. Anything that you can do to digitize the process of all the paperwork going back and forth can shave off days. And it doesn't necessarily mean, I'm not saying that they're going to put a $165,000 deal on a credit card, but I am saying that when you've got things in DocuSign, as a tool, and I'm tool agnostic, but a digital tool that can go back and forth, and the contract collaboration, the redlining, and all that happens very, very quickly. That's a quick win when it comes to compressing sales cycles. And when you're looking at going up market and you're looking for those first couple of deals, shaving 2 or 3 weeks off of a sales cycle, your CFO is going to pat you on the back, and that's a quick win for you on sales cycle.
Absolutely.
So talking about that average selling price, we talked earlier about kind of when you're back in the corner and you don't have another product, you're really looking at price increases. But let's talk about when you do have another product, or you have one product but you're not you have a complex product. And what I mean by that is a lot of companies overlook the power of professional services. And the reason I think professional services is so powerful is when you build it into your annual planning, so it can be counted as ARR. It's not a one-time SOW that's milestone based. And the reason that you do that because evaluations, the way companies are valued, they're going to be valued much higher for annual or monthly recurring revenue or annual recurring revenue versus professional services. So what a lot of companies do from a professional services standpoint, if you have a complex product that takes a while to implement and it takes a while to get people adopted into it, a lot of companies have started offering a managed service piece where you've got one of your employees on your customer service side that makes sure that they're able to get through the product and they're getting people adopted throughout it. So it's helping with renewals. And they're able to charge monthly for that. So the valuation for that money is not just one time and milestone based. And it's a quick way to add to average selling price without increasing your product. You're literally just taking an internal subject matter expert on your product, pairing them up with the right companies, and you need to do a profitability analysis to make sure you're not you're not overextending yourself. But that's another way that you can do it without creating another product. The best practice wise, if you're going to continue to scale a business, if you're going to be one of the $200 million SaaS businesses, you do need another product. That's almost very few companies have gotten that far with one product and even a managed service offering. So you do need to start looking at other products, and that's where revenue operations doesn't always have the control over the roadmap of the company. But it is one of those things that when you build out a model, and as you're building these drivers out, the end product of a lot of this is an annual operating plan. It's very easy to show leadership that you're only going to be able to get a 5 or 10% increase in average selling price. Here's the downstream effect on that, on quotas, attainment, and ultimately what the organizational goals are for growth. And it'll be quickly to see. It's quick to see. Okay, if we're gonna change this level, we're gonna need another product, and then you have to mobilize the executive support around that in order to get the executive team to start creating another product. That's not a small thing, but that's really the average selling price piece.
Yeah, and one of the questions is like, how much before all of the planning phase do you actually discuss all of the different pricing that needs to be broken out into subsegments, etc.?
Yeah, so I think the earlier the better. Anytime that I'm working with a company, even internally or externally, when I look at their average selling price, you model that out, and it's very easy to start seeing how quickly the business is going to scale just off of that one product. And usually it leads into the conversation of, okay, what else can we do? And what's the next play in order to grow that? Because when you're starting out at a $55,000 average selling price, and depending on what your ICP is and what your saturation of the market is, if you're going to have to get to 50% of your addressable market just to get to your goals, that's going to be a pretty hard target. You're probably going to have to start looking at other companies that can fit that profile, and start targeting those, widening that, and then possibly creating products for the current portfolio so you can kind of double thread that problem. Because those are your options. Because just because you're selling your product to one particular segment, you're not stuck in that segment. But it is hard work to go figure out another one. It's not an easy thing to do.
Absolutely.
In talking about that, I was actually talking with the consulting firm yesterday, and going through those ICP exercises. I do think if you haven't done it as a company, it's worth it. And what I mean by that is, as a deliverable, you should come out with a primary, secondary, and tertiary ICP that you should be testing on a regular basis. And where that kind of comes into ramp time and everything else is you end up having better conversion rates if you got a way to get into that. But I don't want to get into the marketing side. It's just a conversation that I had yesterday. I didn't want to forget about. But when you're talking about conversion rates specifically, in sales is going to be handling more of the middle of the funnel. And conversion rates, there's a lot of different ways to look at conversion rates. When you're talking about sales, and without getting too far into the marketing piece of it, the conversion rates, it's important to know which one of your salespeople are converting at which channels at the highest level. So a lot of times what you'll hear is, oh, our digital channel on this particular keywords it really does the best. But when you really start peeling back your onion, the layers of that onion, you start realizing that it's particular salespeople that are doing really, really well in that channel, and it's throwing your averages off. And the reason I say it that way is when you start looking at channels and you're looking at particular people's performance, can come somewhat is controversial sometimes, is your routing system will always be improved, and your conversion rates will always be improved if your routing system is performance based. Meaning if you know the channels that you should be funneling to the right people, then those have higher conversion rates. And a lot of times that can lead to the conversation of salespeople going, wait a second, what's fair? I didn't get, they got more leads. And I can tell you the way that Salesforce approaches a lot of these things is once you're certified in a particular product and channel, that's when you start getting leads for those channels because your conversion rates are up and you're required to keep those conversion rates up. So the reason I bring that up is Salesforce has done a good job of changing that conversation from fairness to education. It's not about you didn't get the lead. It's about what can we teach you to make sure that you're delivering the prospect experience that the prospect needs in order to be delighted and buy more products. That's why we're all here. We did say we're getting up and going to work. We're not getting up and going to fun. So we have to be able to delight our customers. And so when you really break it down that way and change the conversation from it's not fair to, okay, I need to learn what this person's doing. And really, hitch myself to them. And so I figure out how they're closing in those channels so I can get more. I think that's where conversion rates become very, very powerful and very controllable on the sales side. But then there's also the flip side to that is, if your conversion rates are high enough, I'd be going up the funnel and saying we're probably overqualifying. And I can give you some broad numbers, on SMB and mid-market. If you're getting to a demo with the decision maker, you should be closing 1 to 4, 1 to 5, so 20 to 25%. When you're talking about your enterprise, if you're getting to a true technical validation on enterprise, you should be closing at least half of those because that's a lot of money typically on an enterprise to do a full technical evaluation. So those are those are very thumb in the wind. There's always going to be businesses that fall in and out of those. But those are good examples of if you're hitting those thresholds, you probably don't want to spend a whole lot of time trying to figure out how to squeeze more blood out of those particular stones. There's other areas in the sales cycle that you could focus on.
I have a question here from Christian who says, how do you manage onboarding of new sales team members? Even if they have experience in sales, they need to learn about the new products and services. What makes them succeed in sales with new products and services? Any advice to share there?
Yeah, I think it really depends on the company because particular companies are going to have more complex products. And the more complex the products, typically that's where you're going to have to rely on your technical knowledge. You're probably going to have a solution engineer involved, and your relationships, your Rolodexes might not be as worth as they are in a product that's easier to understand, has quick product or quick market adoption, and people just get it right get it just by showing it. So I think the answer can it differs on the approach. But I do think tailoring your approach for what kind of market you have is important, and making sure that you can respond in a way that addresses those nuances is important, not having one specific approach to it.
Absolutely. And then there's the question of how do you then shorten the learning process?
Yeah, so what I love about salespeople, and this comes from I started my sales career as a full cycle AE. The best way that I've learned is find one of your better salespeople and watch how they work. They will come up with some of the most creative shortcuts. And it doesn't mean that you sit there and say, "Oh, that's a shortcut. They went around the system. They shouldn't have done it." No. Think about how to operationalize the brilliance of what you see in a salespeople's day to day. So if you haven't sat down with your salespeople and went through how they're going through the processes you've set up, I'm telling you, you're probably doing your team a disservice because go and do yourself a favor. Do some high performers and some low performers, so you can see the difference in the way that the systems are being used. But help your let your salespeople help you design the systems to make them do their jobs the fastest. Some of the most brilliant ideas I've ever seen implemented in systems, I can't take credit for. They came from a salesperson that said, if it did this and did this on a daily basis, I could get to X amount more. And then you execute on it. So I do think experience is going to show you some of those answers. But when it comes to pure innovation, I always look to the sales team, because those teams are typically very, very brilliant.
Then I have another question, taking us back into the annual planning. About the annual growth planning, which indicators or variables do you use to compound your team dimension, tool resources, and others to set up your budget plan?
Yeah, so it's a good question, and there's kind of two steps to it. Is you've got your plan drivers is the way that I think about it. And when I'm talking about plan drivers, what I'm specifically, we went through some of them, but things like knowing what your last year ARR is, what your over assignment for quotas, what your expected year growth, your expansion percentage expectation, your expected churn, your average selling price, your sales cycle, your conversion rates, top, middle, and bottom funnel, your productivity for each individual role. So your AE productivity, your SDR productivity, your SE productivity, your customer success productivity, and then overall estimates for other lines of the business. And those, I think comprehensively, if you have all of that put together, that's kind of the base of it. And then you start putting together hiring plans, which with some math and everything else, it starts telling you what your coverage is. And once you have your hiring plans in place, your hiring plans are now producing the cost. And now you're comparing your cost to all the other variables that you put together. And I can go through a couple examples of those. If we want to get in some detail at some point, but that's the way that I typically look at it, as the first plan drivers, and then start building those hiring plans to start filling in what the plan drivers are asking for.
Absolutely. We can move on to the next section now. When I have more questions, I'll shoot them your way.
Yeah. Okay, great. So when we're talking about the main drivers, and bear with me as I'm just looking at my own notes, but we were talking about the main drivers specifically for marketing. The things that I see that there's challenges is when you having the right staffing for lead generation, your monthly budget allocation, orchestrating your messaging between the systems, and your channel analysis, specifically meaning diagnostics versus forecasting, and even sometimes your larger events, and securing how does a marketing team secure a large event on a regular basis. So we'll touch on some of those, and we can stop. Please, we'll stop as we get into it. But when I talk about the right staffing, the thing that I always consult and recommend is, when you've got a small team, your first hire should always have experience in more than one channel, preferably 2 or 3 channels. And the reason I say that is, even if you've done the best analysis in the world, you can have 2 businesses side by side, and for whatever reason, a channel just doesn't work. Maybe the brand name, just for whatever reason, just doesn't click with that channel. I don't know why. But don't, as a marketer, and I know I'm preaching to the choir when it comes to all the marketers here, don't assume that a channel is just going to work because it's worked in the past. So the right staffing from a lead generation standpoint is making sure that first channel manager comes in and can pivot from social directly to digital paid ads, or they may start hosting webinars. Obviously they don't typically go to field, but maybe if they've had field experience in the past, being able to move over into that channel and support that channel. And the reason I say that is, it's important to not just continually have to hire program managers as channels fail. It's important to try to hire channel managers that have multiple coverages, so you can test those, hold on to those people, because those people will help new people as they're onboarding come up to speed faster with the entire marketing team. And that momentum, without having to switch people out, creates a very, very good culture for the marketing team, because the longer marketing people are there, Because in my opinion, the business cycle for marketing is longer than the sales cycle, because you're building brand. You're really getting awareness out there. The longer your marketing people are there and your program managers are there, typically the richer your funnel is and the deeper that tribal knowledge that truly brings good leads to the salespeople that everybody talks about. That marketing, where's my good leads? Well, they come from seasoned marketing people. So that's what I mean by staffing for lead generation, is making sure you've got that coverage so you can hold on to them long term. When I talk about monthly budget allocation, it's really about making sure that when you do have the math put together, so those plan drivers that I've talked about, if you've got last year's ARR, you know what the average selling price is, and you know what your conversion rates, you can quickly do math and figure out how many leads you need per month seasonalized. It's really quite easy. So now that turns that conversation to talking to your program manager for that particular channel and says, let's just make up a number. Program manager, I need 1,000 leads. Can you support 1,000 leads a month? Well, then the program manager should go in and look at the particular channels that they're going to use: content syndication, webinars, digital paid ads. And they're not going to do it 50, 50, 50 or 150, 33, 33, 33 or 50, 50. They're going to split it up how they deem. And it's probably going to be very thumb in the wind at the beginning, but it will start dialing in as you get more data. And the idea there is now you're tying the program activities to what you're expected to provide for those leads. And you've got a dedicated manager that is looking at that, monitoring it on a regular basis, and then coming back and saying, hey, we fell short, we need more from another channel. And just right off the bat, I always tell, if you at least half the leads, should be a dedicated person. If you're starting to get half your leads from one channel, you need a person managing that channel, watching it like a hawk, because that has started to become a lifeline to your business. It's very important to understand anything that happens in that channel. But that's how I would say to start off from a program standpoint. And the reason you need that monthly budget allocation is that's also how you're going to figure out what your customer acquisition cost is, so you can figure out if the machine that you're building is costing too much. And are you growing, or are you sustaining profitability, which those aren't necessarily the same thing. It leads back to the first point that I made. So that's really monthly budget allocation, is getting a commitment from the program managers that, yes, those are the leads that I'm going to bring in. These are the programs that are assigned. Here's the cost associated with it.
Do you also build in a flexibility already at the start?
I expected flexibility. So you always model out something that looks, optically pleasing. Hey, we're going to do this a quarter, this a quarter, this a quarter, this every other month. But to your point, it usually like finding out, and I'll use this as an example. If you've worked globally in Europe, nothing happens in August. And if you've got a bunch of programs that are running for marketing for that, it's probably not the best thing to be throwing a bunch of marketing messages in people's vacation boxes. So it's one of those things that, you should definitely move that around. But for the net of it, from a cost standpoint, you do want to at least have placeholders in there, so you're getting projections for cost, customer acquisition cost, lifetime value, payback period, and making sure that the engine that you've created is profitable and sustainable.
Got it.
So moving on to the orchestrating the messaging, the piece I'd just like to touch on here that I see so commonly is, we have marketing automation systems and we have prospecting systems. And what I see commonly, almost every company that I've joined or consult with, is there's not great orchestration between those, from prospect to customer to advocate. And the difference that I call an advocate to a customer is, advocate is a customer that will find another customer for you. A customer is someone that signed with you. A prospect is someone that hasn't signed yet. But making sure the orchestration between that is very, very solid and has continuity to it is important. And a good example of this that I've seen is, a lot of times leads can end up in a nurture status where the marketing automation system will be firing out particular information to them, not knowing that the prospecting system is also doing something similar. And so now that person's getting thrown into spam, you're burning the contact, you can't map out the organization, and you're frustrated and you're trying to figure it out. And it's really just an overall systems piece that revenue operations should have and this is, I'm actually currently in this process, you should go through and map out the journey of the prospect, customer, and advocate orchestrate what systems will be touching them, make sure there's continuity between those messaging. So, usually when you start conversation with an SDR in some way, shape, or form, you would cut off the conversation with a marketing automation system for a while to make sure. When you're going over to be a customer and they're in implementation, you probably don't want to immediately start sending them out newsletters and new functions that they haven't been implemented yet. So there's, a time that should probably be suspended until they get all the customer comms. So you can see those are just a couple of examples to make sure that the orchestration comes across as the company knows what they're doing, and they're doing it in a way that is leveraging the customer experience, and they care that they're sending out a message that makes sense, that customer is going to turn around, become an advocate, and say, these guys really got it figured out, or gals. So jumping to channel analysis is really the last one that I'll touch on marketing. I think we're right at the half hour, so we could touch on the last point and have some more questions. But the channel analysis, the reason I bring this up is there's two ways to look at it. You've got channel diagnostics and channel forecasting. Excuse me. I tried to mute and still got that recorded. So anyhow, but channel diagnostics and channel forecasting. Channel diagnostics is what you're trying to do is you're trying to figure out what channels are producing the most for you. And the reason that it's important to separate the thought process between those is the approaches are different. You're going to want to know from a channel diagnostic standpoint what channel and sub channel are producing the best, and you're going to want to know that at the most detailed level that you possibly can. So social, Facebook, and then if you've even got a sub channel to Facebook to maybe a particular group. You're going to want to know that, or the other example from a digital ad, you go all the way down to the very specific UTM, and know that. The reason you want to know that is channel diagnostics is about where your budget's going to go, and you want that level of fidelity when you're working it out and asking for budget. You need another $15,000. We need to be able to show that channel is producing well. If you've set up your performance routing, you'll notice that your channels will get better and better and better. So those things kind of go hand in hand. But when you're building an annual operating plan, it's much less important to figure out what the conversion rates are on every individual channel than it is to figure out what the overall average is across the channels. Unless you just have one channel that is contributing 90% of it, you want to make sure that risk is at least known to the team, that 90%. But that's a bad place to be in a marketing spot if you're getting that from one channel. But the point being is when you're forecasting, you want the average, because your average is going to tell you, if you've got 3 or 4 channels, it's going to give you the flex that you need to. A channel is going to go down because, maybe did digital keywords. You've got a competitor that are all of a sudden started up a big digital ad campaign against you. So you're going to have to shift some of it. If you've done your forecasting that way with averages, you should have the leeway to figure out from other channels, how am I going to be able to increase on the other sides. And using your channel diagnostics, you should be able to look and say, okay, well, what channels and people are performing the best, so I can start cranking up the spend in those particular areas, funnel more leads over until I can address what the competitor is doing to the digital ad campaign.
Absolutely. And how do you also look at it in the similar way when it's about existing markets? And what about if you want to launch into new markets? Do you look at it differently?
Yeah, I mean, it's kind of it is one of those things. It's a monkey see, monkey do. You need to figure out what's happening out there and figure out what you want to copy versus what you don't. The follow-on motion, with a competitor that's really taking off, follow-on keywords is a good strategy in a lot of companies. That can save you a lot. Not getting that second bid is not always the worst thing when you're a small startup and you don't have the budget for it. But when you need to be the budget leader and all of a sudden, that's bringing in 90% of your good leads, and all of a sudden a great competitor comes in and hits you with it, that's a completely different story. And so I really think it's about when you get into those unforeseen, because you don't know what you don't know. But if you've got plenty of channels in place and you know who is producing from those channels, then when you do run up against something that's completely unforeseen, you'll have a lever to pull. And that's my whole point, is don't have 90%, 80%, even 70% wrapped up in one channel, because when something crazy does happen, the lead flow is going to be drastically interrupted.
Got it. We have a comment slash question here. Generally speaking, how many months, days do you need to see suboptimal channel performance before you have enough data to recommend a pivot in channel strategy?
Yes, I think it varies from business to business, and I do think the way that you get a good sense of it is what is your total sales cycle. So if your total sales cycle, is 8 months, 9 months, 10 months, you're probably going to want to run a channel much longer than if your sales cycle is 30 or 60 days. But you do want to start coming up with what is that time frame, and then start measuring it. So specifically, how long does it take to MQL a particular lead, and making sure that your scoring strategy is in place, and making sure that that MQL turns into an SQL that eventually turns into a lead that's going to close. And when you kind of have all of those things wrapped up, the reporting and figuring that out becomes a lot easier. But if it's not set up that way, to your point, it's kind of a bear to try to tackle it.
Got it. Thanks. We can take some questions now. So if you guys have more questions, drop them in. And maybe, David, you were talking about this magic worksheet that you have. I don't know if you want to quickly take us through a little bit of that and give us a little bit of a demo of how you build these plans.
Yes, yeah, happy to do that. So I'll jump in to it's a simple annual operating plan. And when we were talking about plan drivers, this is really what I meant by the plan drivers. And so I can't maximize that, blow it up a little bit. When you have everything laid out, like this plan starts at 2023, we could change it easily from one of the inputs, but all of these cells are input cells. And all of these metrics on the left-hand side are the metrics that it's asking. A lot of these come from, not all of these are come from Salesforce. A lot of this is going to come from analysis from your finance group. But once you put all of this together, that's why I call all of these plan drivers. And if you know your last year ARR, your over assignment, your year growth, your expected expansion, your churn, your average selling price, what sales cycle you have, what you expect at your top of funnel, your middle of funnel, and bottom of funnel conversion rates, what you expect your productivity is going to be, what your seasonality looks like, what your intra-quarterly seasonality, and then you can create an income statement. If you can make this a function of ARR, you can make this a function of a flat function if you move over into the income statement, and I'll show that at the tail end. But the point is to be able to project an income statement, which allows you to project the cash flow statement. When you're able to do that, that buys you a lot of credibility with finance, because you're speaking the same language. Your numbers probably won't line up exactly, but they'll get very, very close, and allows you to have some pretty detailed conversations. And I'll give you an example here in a minute. But once you have your plan drivers in place, you'll notice that the next piece is really looking at, well, how many AEs do I have? So the way this sheet is built is I'm really just copying and pasting more people. And if you look here, I'm looking at coverage. And so as I'm adding people in, you can see the coverage is going up. And if I want to add them at later dates, what the sheet will do is it will change where that coverage is, and allow you so you're not hiring people too early. And so I always start out with AEs, because your AEs are usually that's how everything else is going to be built from a new sales standpoint. Because then you jump over and you want to know, okay, well, how many SDRs do I need from that? What is their coverage going to be, which is listed here. Again, if you've got SEs, you'll have a coverage area, and you can start adding in the SEs, their hire dates. And you'll notice it produces quotas for each individual employee. Marketing is the next piece. Once you get your SEs and SDRs figured out, you'll notice here I've got 3 program managers. And the idea here is, you started out, as I said, this is 1166 leads that they need per month. But if that's too many, then I would add a program manager until we get to a level that they say, okay, that's the amount of leads that I need. I think I can handle that. And then you create what channels they need and what they need each month in order to be able to be responsible and be confident that they can produce that number of leads. The only other piece on marketing, and I know I'm moving quickly, but I want to make sure I get through this, and then we can take some questions. The other thing on marketing that I would bring up is the larger investments piece is a piece that gets overlooked. And the reason I say larger investments are things like Dreamforce, or if you're in the security side, RSA, or if you're overall in SaaS, the SaaSter. These are big events that require a large investment, and sometimes those investments don't always match the revenue. So if you're a newer company and you're having to buy a $50,000 booth, if you're going to allocate all of that to the sales that you expect that particular year, you're going to have a very, very, very low magic ratio. You're going to have a very high customer acquisition cost. But what I typically recommend is to spread those investments over the 3 years, capitalize them as a financial principle. And I've had a lot of success doing this, talking with finances. You have a C-level executive, typically the CMO, commit to the fact that, yes, this is what we're going to be spending over the 3 years for these events, and the revenue is going to be increasing each year. And then what that does is that it makes it where the very first year doesn't look terrible, and it increases the odds that that event won't be cut. This is one of the common areas, because accounting is very much the amount of people they have is the unit economic by which work is exercised. So they'll very commonly look and say, well, let's just cut an event. We've got the program managers, they'll work with the digital channels and the other channels they have. We can cut these events and probably save quite a bit. But if you need to be there and your current customers, or you need to make the splash that you need to, that's not always going to be all allocated to customer acquisition costs. Some of that's going to be in branding and some other different things. So this is a financial way to spread those investments out and make sure that they're not cut from your plan. And that's why, if you notice here, there's no coverage. It's really just talking about, well, as you're increasing, an event to $100,000, what are you doing to your customer acquisition cost and your magic ratio? And it's not increasing it by a significant amount. It's spreading it out over those 3 years. The last piece is really customer success. And this is making sure that you've got the coverage as you're going through your plan. So the reason you might see a larger coverage model here is a lot of times you may measure customers by 1x, 2x, or 3x. That's very common on the customer success side, from complexity, and that complexity can represent things like number of CS that it takes. Maybe a 3x customer requires 2 customer service reps and an account manager, and they're divided up to customer service reps or your day-to-day, and your account manager comes in and helps and does upsells, cross-sells, and renewals. Whatever that is. But that's how you're building your capacity model. And you just want to make sure that you've got the coverage for customer success. And the reason that you have to include them is, without average cost of service, you're not able to calculate things like your full payback period. And then compare that to your lifetime value of the customer to make sure that you're overall profitable. So that's really the inputs. You've got your plan inputs, your AEs, your supporting from SEs and SDRs, your marketing folks, and your CS. And then the output of that, what really happens is, now you get this ratio calculation sheet, which what it does is it sums up all of your sales cost, all of your support cost, your marketing cost, your head count. You should include your stack cost. This is something that very commonly gets forgotten. Is your go-to-market stack technology cost should be allocated, and you should have it split up for the cost that's associated with new sales versus existing. And a good example here is Salesforce versus Service Cloud and Gainsight. Should be split up, because one goes into the average cost of service, one goes into your customer acquisition cost. New being your new sales going into your customer acquisition cost. This going to your average cost of service, which ends up helping calculating what's called your full payback period, not your customer acquisition cost payback period. Your full payback period, the difference is it includes the R&D costs and the G&A costs that it takes to maintain those customers, and the customer success people's salaries in order to service those customers and get them to renew. When you have the cost in there and you've got growth, your growth targets, you can produce a quick matrix that tells you, here's what your last year's ARR is, here's what you're expecting to churn, your new bookings, your expansion. It'll tell you what your coverage to target is from an AE standpoint, your net dollar retention, your customer acquisition cost, and obviously you want to see that that's dropping as you're scaling. And this is typically a function of quotas increasing. Your lifetime value, your LTV to CAC ratio. This is pretty high, and it's because this is using the gross margin estimate, not a cohorted amount. If it was a cohorted amount, this would be much more accurate. Then your magic ratio. This is actually pretty high and pretty lean. Usually this is below 1. And then your payback period. letting you know. And so there's a lot of benchmarks that go into these. Like if you can get a payback period that is close to 9 by your second or third year, that's a pretty good benchmark. But what that does is that rolls everything up into here's the hiring plans, then here's the financial statements, and you end up with a financial projection. And you can see this is what an income statement would look like. And the reason I say it's projection is not everything's going to be exact, because some of these things will fluctuate from cost of G&A and R&D. But it gives you an overall of, if you were going to run this business as we have it set up, we would actually run the cash balance out to about $172,000. So we would know we would need to borrow $200,000. What that's going to do is tell us where our minimum cash balance is. If we had to borrow that money and instead of get it through equity, you would see that we would probably need to borrow a little bit more, because now we're servicing that debt. But where this is really powerful for those that I've totally lost because I'm in a sheet and it's making people's eyes bleed, is when you go to the plan inputs portion. Let's say that you want to have a conversation about, well, we need a little bit more R&D in 2023. We've got a little bit more tech debt than we had expected. A lot of times that conversation turns into, well, what is your FTE? Let's remove an FTE, on the go-to-market side. Well, remember this 7974 number. If you go over to the plan inputs and you increase that to 35,000, now you can go back to your income statement, and that 7974 is now 46,000 negative, and now you've quantified that decision to a $53,000 decision, which now you can say that's not even an FTE. So it changes the conversation from, let's not cut somebody from go to market. Let's either burn that cash or let's ask for more cash if we're going to the well, and build in that instead of cutting that head count. And so that's where the real power comes from, having an income statement produced from all of that, and allows that conversation to just be very, very transparent in a dollar amount. You'll obviously get a full, what does the pipeline look like? Then what is bookings? And then I built a front end, and the front end gets rid of all the sheets. And what I really like about the front end is it does things like summarizing your income statement. So taking that income statement and asking questions like, where can I cut 15% to make the largest impact? And this is actually OpenAI. It's ChatGPT 4.0. And it's not hallucinating the way it's set up. These are doing proper calculations based off those income statements. And that allows you to get in, build it, have a front end, ask questions, and then get with someone that can go through that with you at your pace. So you can ask a lot of the questions on what's confusing, what's not, and kind of go from there.
I think we have a couple of questions around if you could talk a little bit more about what's the magic ratio, what does it stand for?
Great question. So the magic ratio, in and of itself, is not a very useful ratio, because even if it's positive and there's other parts of the business that aren't very successful, it doesn't mean much. So I'll give you an example. Is the magic ratio stands for every dollar that you put into sales and marketing, you get that back. So when it's a fraction, you're burning cash. Meaning every dollar that, if it's 3/4, then every dollar you're putting in, you're getting 75 cents back. If it's 0.25, every dollar you're putting in, you're getting a quarter back. And everybody knows in business, everybody in the world will trade a quarter for a dollar every single time they make that deal. But what it does is it represents the investment that's needed in order to get a system to start to scale, because your quotas and your productivity are typically not going to be able to carry the cost that's associated with it. Which is why SaaS is so attractive, because as you get more customers, you get that customer base that's under it, that produces revenue, and it takes much less to maintain them. And so slowly that ratio starts getting much, much better, because your quotas are increasing. The amount of customers that you need to attain are typically more valuable, and there's a less number of them. And so that's as the business scales. And so you want to see that number typically go from some fraction in the first year to some number between 1 and 3 in your second year. And then in your third year, over 3 if possible. Right now, with the way growth rates have been happening, over 3 in a third year, as I've modeled it out, is pretty hard to do unless you're getting above about $1.5 million quotas, and growth rates that are above 65 to 85%, which is very, very few companies are doing that right now.
I have a few questions lined up. Maybe this one takes us away from what we're discussing right now, but going back a little bit, would you mind sharing some insights on how do you plan for a product company that is yet to make revenue?
Yeah, so I've done this several times, and I think the best thing to do is get as much as you know out there from a confidence level and get a plan in place and know that that plan's going to pivot. Some of the strongest companies that I've seen have great starts, have plans in place that they absolutely wreck their first 3 to 6 months, but they've always got something in front of them, and they've always got a plan in place and a pivot. So knowing what channels are working, knowing how you're going to map this out, having a growth target that's reasonable. And when I mean that, what I mean by reasonable is, don't build your company to a $1 billion company in 4 years. That's not going to happen. Put reasonable targets in there. And then when you come short of those targets, be ready to pivot. If you've lived in the startup world long enough and you've been or touched on founding or co-founding, we eat a lot of crow in that process, and that's about pivoting and learning what we've done wrong. But I do think having a plan in place and trying to strive for it from a team cohesion standpoint, it really just brings momentum to the team. And I'm all about momentum. I would rather a team do something completely wrong with momentum than sit around and worry about whether or not they're doing the right thing and do nothing at all.
Thank you for that. Next question from Lily is, after completing annual planning and getting approval on the next year's growth plan, at what point do you start territory planning to support revenue targets? Did you hear me? Okay, so I'll just wait for you to...
No, I can hear you now. Just repeat it.
Yeah. After completing annual planning and getting approval on next year's growth plan, at what point do you start territory planning to support revenue targets?
Yeah, so I do them in parallel because you want to make sure that if you don't have enough leads that are going to be able to cover from your territories, then you've got to expand your total addressable market, which is about finding more of a or different ICP. So it kind of goes hand in hand. You don't want to get revenue targets and try to fit them into territories, but you also don't want overplan the territories. Typically, what I've seen work very well is to have build your territories in a way where you're able to double and triple your sales team over the next 18 to 24 months, meaning you can plan for success. And the reason that it's so important that way, and the reason to set that expectation is, as you're hiring people, let them know, yes, you'll hold on to the leads from this particular area or the things that you're working on, but here's what the split's going to look like as we're successful and as we're hiring, because it is important that you don't want to kill team morale when they come in, but you also want to have a notion of making sure that there's, and I'll use an example is, when you're talking about a higher average selling price, a lot of times there's only a particular amount of companies that can pay that. So you want to make sure that, you tier out your accounts, and that your first hiring class of AEs doesn't come in and cherry pick the best accounts. So then the next one comes in and they can't ever get, they can't do their elephant hunting that they all like to do from time to time. So I do think it's important to make sure that you've got the planning in place, plan that you're going to double and triple. Lay the expectation down that, if it's all tier 1 accounts, they're very likely to be moved from an expectation standpoint. And then also be prepared that, well, when you get to that area, then what else do you do? Do you expand to a different addressable market? Because that's about blazing the trail and staying so far ahead that when the idea comes up that you're short on leads, you've already got a plan and a couple of recommendations on this is what we should do in order to expand those territories further.
What are some of the key stakeholders that are important to get all of this kind of working smoothly?
So your head of marketing, your head of sales, your head of customer success, those are the main three. And obviously those all feed into the financial side, so your strategic partner in finance, sometimes that's your controller, your comptroller, your CFO directly, sometimes CFOs, analysts that you're working with. There's a lot of different flavors of that. But really I think the reason I call the go-to market stakeholders is fundamentally we speak a different language. Our unit economic are things like leads, MPS, pipeline coverage, 2x, 3x, all these things that are very foreign in the finance side, but they all do translate through a good revenue model to finance language, to dollars and cents. What is the income statement going to look like? What is the cash flow, the impact on cash flow from those? And I think that's why it's so important when I'm building these, is I work with the head of each department, make sure that I'm understanding what the salary levels are at, what the necessary investments are. That way, when we go and we're asking for those budgets, we're having a very financial conversation, but we're starting from the nuances up from the operational side. And I do think there's a bit of magic to taking bottoms up and top down. And I don't mean that in the sense of, you need a wizard to do it. I mean, in the sense that you really have three languages that are being spoken on one side, one language that's being spoken on the other, and bringing those together in a way in harmony. So everyone feels like not the typical process happens, which you submit budget, you submit it for 20% over because you think you're going to get 15% less. And then they cut 15%, and then you try to go figure out what you're going to do with it. We try to avoid that and have a more transparent conversation.
Got it. I have a question here. How do you calculate TAM for different line of businesses?
So I think there's a lot of ways to do it. And from researching standpoint, I like to focus on what can you sell and what can you expect to sell, which is a lot different than, whether or not there's a lot of different names, from total addressable market to total sellable market to total marketable market. And without getting into all of those nuances, the way that I try to frame it to make it simple is, who can you sell and who are you going to be looking at selling over the next 12 to 24 months, and how big is that market? And you can usually quantify that using, you can either pay a research firm, which is more expensive, or use a list provider, get some NACE codes figured out for your particular industry, or however you're slicing it up, and then start making some generalizations in a sheet and go through a TAM exercise. If you haven't done a TAM exercise for your company, I would absolutely tell you to, because a lot of times you figure out that you need a new ICP just based off of your TAM exercise, because you're gonna run out looking at your conversion rates.
Thank you. I had a lot of questions around, can we get access to this spreadsheet that you shared, David?
So the larger spreadsheet that I showed, that's what I consult and do. So I'm happy to walk through, and there is a free version that is shared that I built with RevGenius. And I'm happy to even help someone if you have your own model, if you want some help working through it. But the actual copy of it, that intellectual property, is the heart of the harmonized product itself. And it is available for sale, but it is not available for free.
Okay, so then everybody has their answers. I thought I'm going to check with you. Somebody says, what the sheet, does it show modeling only for a single product or a multi-product as well?
Yeah, so when you're talking about multi-product, you're typically impacting your average selling price, and you can change, and it can change your conversion rates. So it really depends on how you're going to model that out. If your conversion rates are completely different, then you typically model it out as another segment entirely. If the conversion rates are somewhat the same, meaning it's like a co-selling product that dovetails quite nicely with it, and it's just going to increase the average selling price, then you would bake it into the average selling price that particular way. But it depends on what kind of product it is, how it folds in, and really the heart of how many models you end up creating is there a true new funnel that's being created, either through the new product, through pricing. Like if you go up market, even with the same product, and you're selling for a lot more, that's going to change your conversion rates, things like that. But that's what answers that question on how to model it out, is, does it create a new marketing funnel that need to be modeled out? And if it does, then you model that out, and from a calculation standpoint, you're going to use all of the totals from all the cost that's allocated to that, to this is how you calculate out, LTV for this particular segment. And you can see it can get dicey very quickly. But usually you model out, up to inside of Excel, without using software, you can model out up to 4 segments and 4 regions without it getting too terribly bad. But you get up to about 35, 36 sheets at that level. And then you want to start importing it more into a BI tool and go from there.
I think I'm going to wait to see if there's any last questions. I don't see any more. So I think we've pretty much covered everybody's queries. And thank you so much once again, David. Is there any last piece of advice that you would like to put out there before people think about annual planning again?
No, the one thing I would say is, if you can get your team on the same language level and from a transparency standpoint, and they don't need to speak each other's language, they just need to have the common understanding that everyone's getting what they need in those plans. I can tell you in my experience and even a recent experience that I've had, it's so incredibly powerful to an organization to watch the executives or the heads of those departments come together and truly shake their heads and say, okay, I understand the give and take here. I understand how we're going to work together. Because at the end of the day, the organizational goals belong to all of us. We all align to them. And I do think that the trick is getting everyone aligned on that transparency, so everyone has that same level of understanding. Because when everybody has the same level of understanding, they tend to have the same level of comfort, and that level of comfort allows you to work collaboratively much better. Because it's not always fun with work, but being able to enjoy it when you're working with each other is part of why we do this every day. And so I think it's just really important, if you have the opportunity to get everyone talking in that same language. I can just tell you from my personal experience, it's a powerful thing to see. It's very fulfilling to watch, but it's big shoes to fill along the way, and be prepared to do that.
Thank you so much, David, once again. And thank you everybody else for joining. Of course, I will drop the links on, there's people asking, where can we buy this sheet if it's to be bought? I'm going to answer back to everybody on that separately and send you all links, etc. But yes, you will all get a recording for this, for those who could not see it and wanted to share it with their teams. And once again, thank you so much, David.
No problem. Thank you for having me. I appreciate it. Have a great day.
Bye. Thanks all.